Hi, Matt Batty here again. Just doing a little bit of an update in regard to some of the news around potential superannuation changes that have been sort of floated in the last little bit. So, look, the super short version for anyone with limited time is the best way to describe these are their announcements of potential proposals. So there's certainly nothing set in stone yet, and not even an actual policy. So won't be offended if you turn off now, because there'll be more on this later. But for those who want to know what's being floated as an idea, we'll get into a bit of detail. So first of all, there's probably sort of three components to this. First of all, the Treasurer, Jim Chalmers, has come out with this kind of, I guess you might even call it a manifesto around a purpose of super and what super should be about. So that's sort of the guiding principle, if you like, of where they seem to be going with these potential changes. So that's a whole nother video in itself. So if people want us to pull that apart a bit, we might go into that in a bit more detail in another one, but let us know. But for the purposes of today, there's really two components to these floated potential changes. One is a potential limit on the size that that people can have in super in total. Obviously, there's already limits on how much we can transfer into the pension phase in super, but there's also this proposal of potentially limiting the amount of total capital that can be in super, that is the accumulation account as well. And there's various numbers around 5 million and 3 million sort of being suggested or floated around. And then the other one, which we'll get into a bit more detail in a sec, is around a change in the accounting, if you like, or the measurement in terms of ultimately return performance and then tax treatment for super. And that's a whole another sort of can of worms. So let's deal with the limit first of all. The argument around this is there's a relatively small number of funds, but an increasing number of funds who are accumulating relatively large balances in super. And that's really because of the function of the fact that with the pension caps, you're limited to around sort of 1.7, soon to be a bit more, but around $1.7 million per pension member. So let's call it $3.5 million is roughly the maximum amount of money that can be in super. And if we look at the pension minimum drawdowns on that, that starts at sort of 4%, and those amounts increase as we get older. So someone who's relatively young, say under 65 in super, particularly in recent years when the pension minimums again had been halved, but even going forward under 65, we're only being forced to draw out sort of 4% per annum. And that's only on the amount that's in pension, which might be a maximum of, let's say, roughly 3.4, maybe a bit more if it's if pension being converted in previous years and had grown a little. But let's say roughly say 3.5 million. So if we're only taking out 4% and on average the fund's earning more than that, then obviously that balance in the pension account is going to grow. Now for those who have money, total superannuation balances in excess of that, the balance of their money is going to be in the accumulation phase. And that doesn't need to be drawn. In other words, can stay in the fund whilst that member's alive. And so if you've got people with, say, $5 million in a fund, let's say, to keep the math simple, $2.5 million per person, and only say 1.7 of that is in pension phase, well, then the other sort of 800,000 each, or 1.6 million, is going to be the accumulation phase. And not only is it going to grow with the earnings of the fund, but it's not even going to be depleted by that pension drawn out. And so in that situation, you've got these funds that are growing in total balance because the members aren't drawing out more than the fund's earning on average each year because they're not being forced to. As a result of that, with a decent investment strategy, some compounding for a few years, you can start to get some funds with some relatively large balances. And that's really what Chalmers is sort of alluding to. He's saying, well, these funds are getting these tax concessions, and if we extrapolate those tax concessions over time, and we'll get into the math of that in just a second, but if we extrapolate over time, people with large amounts of capital in retirement aren't really using that money to fund their retirement, and therefore maybe they shouldn't get the same tax concessions. Now, there's a few problems with that assumption. First and foremost, it's another attempt at tinkering with the rules, which obviously makes something that is supposed to be a long-term strategy less attractive for anybody. It's certainly in the earlier phases of superannuation, particularly in people, let's say, in their 30s and 40s. Not only does it mean that super, is yet again potentially being sort of played with, but the penalty is going to be for those who accumulate super, either large amounts of super very early and therefore would compound their superannuation more over time, or people who, for whatever reason, are luckier or more fortunate in their investment strategy, and therefore their returns and their earnings are greater and therefore compound greater over time. So on the surface of it, doesn't really seem like a great policy if you're trying to encourage people to accumulate super for the long term, because obviously, this continual sort of, tinkering with it, and in particular limiting the potential viability of something that you already, having to sacrifice the accessibility of that capital, that makes it less attractive. And it really comes from this idea of the way Treasury look at tax concessions. Okay, so when Treasury sit down and do model different sort of scenarios around what are the impacts of particular taxation policies, they run a calculation based on a marginal tax rate alternative. So in a really simple sense, what they do is they look at, say, hey, you've got $1 million in super, and that's only going to be taxed at 15%. So if you earned, say, $100,000 in a particular year, then the super fund's only going to pay $15,000 in tax. Whereas if that $100,000 was earned at your marginal tax rate and you were on the top tax rate, you would have paid $47,000 in tax. And therefore that $32,000 difference they regard as a cost to the budget, because it's money that they haven't, that they're not able to receive. Now they recognise that obviously it's not as straightforward as that, and people would adjust investment strategy, tax planning strategy, structuring, all sorts of things alternatives. So it's not an actual cost. It's not money that they have handed out. It's not a rebate. All right? It's not a refund. Okay, it's money that they, in theory, could have collected up to a maximum had situation been completely different. Now, is it fair to call that a cost to the budget? Well, it depends on the purpose, right? So if your purpose is to try and understand the relative long-term impact of one policy versus another, arguably that's a legitimate calculation. To then take that though and pretend that that's an actual cost, that's an actual concession that these people are receiving, is a stretch to say the least, right? Because the likelihood of running an investment strategy in a higher taxed entity that's exactly the same as one that's in a long-term, low-taxed accumulating entity, we just don't do it, and no one does, right? So to try and pretend that that same amount of assessable income would be taxable in the same year and would be taxed at the top marginal rate, and there'd be no other planning or no other deferments or no other things involved, is just insane. So that's probably where we have a real problem with this idea of a cost to the budget is money not received. It's like a business saying, look, one of our biggest costs this year is all the customers who didn't come and buy our product. It's not a cost. It's not even an opportunity cost, right? It's something that didn't occur. It's arguably quite legitimate for the purposes that Treasury at least initially use those numbers for, and that is to look at the potential impact of policies. But to extrapolate that out and start to pretend that the concessions that a superannuation fund is getting is the same as or more than the liability of the age pension, which is really what they equate this to. They say, oh, the age pension costs X billion dollars, and the concessions, the money, the tax we don't collect, we can do a calculation that suggests that would have been greater, and therefore that's unfair. It's either really poor math, or it's, let's just say, negligent. There's probably no better word for it. So again, okay calculation contextually, but to then use that calculation in a universal sense and pretend it's the same as real money being handed out to people, that's an actual cost, that's an actual payment. Someone has to physically fund that. To turn around and say money we haven't collected is a cost, that's a stretch to say the least. But that's essentially where this sort of concept is coming from, and saying, okay, well, if we're not collecting all this revenue that we could have, we'll pretend that's a cost, and therefore we will use that as an argument to change our concessions accordingly. I would definitely say that that's a big stretch, and one that's going to be very difficult to pass politically going forward. So that's kind of where they're coming at in terms of, though, balancing, the amount paid out in age pension versus superannuation. What they're not saying is the effect of the age pension calculations over time will change as people's asset values, and particularly their super, change much faster than the rate of inflation and the accessibility for the age pension itself. But that's a whole nother discussion. So probably the more troubling, and this gets to the third part of what's been proposed to potentially be announced, is probably the way I'd put this, is this idea of taxing what's referred to as notional earnings. So one of the problems we have in a superannuation fund, if you were comparing, let's say we're comparing returns, for example, and you've got one fund that's returned 10% in a particular year and another fund that's returned 10%, have each of those funds do they have the same amount of actual return? Well, the answer to that is, well, it depends on how that return was generated. And so what is the after-tax position is probably the more important. So for example, if Fund A has earned 10%, but it earned it all as assessable income in that year, that 10% is going to be assessed, let's say in the accumulation phase at 15%. And so the net return to the members is going to be 8.5% or 85% of the actual earnings. Whereas if Fund B has earned that 10%, but it's purely in terms of a mark-to-market valuation, i.e. an unrealised gain, that is the value of the assets have increased by 10%. Well, in that fund, when it does its tax return, there's no assessable earnings yet because it has not realised those gains. And so the after-tax earnings at that point is 10% on a year-to-year basis. Now, which fund did better? The 8.5% fund or the 10% fund? Well, they both did 10% in gross terms, but from an after-tax position, we can start to get a degree of variability. Now, a lot of funds, let's say, use this variability in accounting, if you like, to be able to publish returns that are, let's say, not as transparent as other funds. And one of the ways to go about fixing that is to look at, well, what would the fund return be in an actual after-tax position if we were to assess both funds accordingly? Again, that's a very legitimate calculation if you're trying to assess the underlying performance of the funds, but it's really not a very good measure because in one sense that money's been earned and received, and in another sense it's really just a movement in unit prices. So for example, on the day, on 30 June, if that fund was up 10% in unit price but dropped down that day and then was up again the next, the fact that we've arbitrarily picked a day in between starts to make the waters quite a bit muddier. But where this is really going to get a bit problematic is looking at using this notional earnings, this 10% unrealised gain example in Fund B, using that to actually tax the fund. So in other words, Fund A, which had its 10% in earnings, it had physical cash flow with which to then pay the tax. Fund B doesn't have any cash flow because it's only seen a rise in asset values, is also then going to be taxed at 15% and have to pay out that 1.5% in tax. Now, if the fund doesn't have the cash flow because it's an unrealised gain, nothing's been sold, no money's been generated, no cash has been generated as a result, you've now got a liquidity problem in the fund. What does that mean? Well, it means a whole bunch of things. First of all, it means, well, what provision does a trustee have to make to ensure that the fund has adequate liquidity? And that means if it gets increased valuations in its asset base, it's going to have to sell assets to be provisioned for that tax liability. Now, what happens if that tax liability doesn't eventuate? What happens at the end of one financial year? The market's had a run up. It owns a bunch of US tech stocks in recent years would be a good example. Owned a bunch of Bitcoin, something that went crazy and inflated the price. At the end of 30 June, we then draw a line in the sand and say, okay, we've now got a notional tax bill of X and that money has to be physically paid. Okay, so the fund's now going to have to sell off some assets to do so. What if next year, for a whole host of reasons, the asset values in the fund reduce? The market's down that year, maybe some of the investments don't do so well, the fund value is now below what it was last year. What happens to that tax that's been paid essentially in advance? Does the fund now get a refund, right? What if the fund never recovers that value? There's a whole bunch of long-term calculation concerns that come into how do we treat not just the liquidity and the investment strategy fund, where a fund would have to sell assets in anticipation of potentially paying a tax bill, which itself might not eventuate because what if the return's up for the first half of the year but down for the second, for example? Or what if there's an inflated valuation, say, residential property in the last couple of years coming out of COVID, for example, then experiencing sort of 5 to 10% or even more reductions in notional value in valuations, but because we don't have a mark-to-market valuation, we can't be precise one year to the next. How do we handle that scenario? So suffice to say, this is probably the most complicated change you could make to the taxation and administration of a fund. So because of that, we would expect that this will not be part or even ultimately proposed as an actual proposal, let alone be passed into legislation. There are a myriad of fundamental problems that occur, not just in basic running of funds, but particularly where funds start to own a lot of unlisted assets, where there's limited recourse borrowings, where there's interchange between generations. There's a whole myriad of calculations that will be horrendously complex and make many of the relatively complex calculations that super's been subjected to in the past that have now been simplified. It'll make them look like a year 3 math problem. So we really don't think this is going to get up. It's a horrendously bad idea. So yeah, we don't think it's really anything to worry about in the long term, but obviously we'll be keeping an eye on it, and we'll certainly be supporting the various proposals and feedback from different associations, organisations that we're associated with, to make sure that the government and Treasury start to understand the Pandora's box that this would involve. So look, at the moment, yes, it's an absolute nightmare sort of scenario, but it's 3 or 4 iterations away from reality, and so far beyond the realm of implementable that at this stage we'd say there's virtually no chance of it getting up. But obviously we'll keep an eye on it and keep you posted. So appreciate there's a little bit of complexity with that, and wanted to give you a bit of a taste of what that's like, but obviously rest assured we're following it very closely. And the bottom line is, as with all these changes, there's always plenty of other options, which is again why that sort of notional tax idea of Treasury pretending that there's a cost to the budget of tax that they don't collect. In reality, they're not going to collect much, if any, of that tax, even if they brought in a proposal that suggested, that they will. So there's always, other options in terms of, managing those changes as they come in. So that's our update for now. Nothing to worry about at this point in time, and probably nothing to worry about until at least the next budget, which is sort of May next year. So yeah, I would say, flip the page and catch up on the sport. As always, if you've got any questions, let us know. Happy to go into a bit more detail. If there's people want to know a bit more about Jim Chalmers' 6,000 word sort of manifesto, happy to go into that into a bit of detail if people are interested, because that's the fundamental, I guess, ideology that's sort of driving these potential changes. But we'll leave that for another video. Thanks again.